Hi everybody, and welcome back to video number 4 in chapter 10. When we left off, we were looking at how we would disclose asset impairment. And here, Macy's has a couple of notes. And under note 4 here, under note 4 here, restructuring, impairment, and store closing and other costs. And they give a little description as to what happened during the COVID-19 pandemic. And also in note number 14 here, they show how they use fair value measurements and concentrations of credit risks and how that impacts long-lived assets. Okay. So in this case, what if we have to restore impairment losses? So at December 31st, 2024, Kodak has a piece of equipment that assembles disposable cameras with a carrying amount of $500,000. Given that most people carry a cell phone with a high quality camera, sales of disposable cameras have declined. Kodak determined the equipment was impaired and wrote it down to its fair value of $400,000. At the end of 2025, disposable cameras started to make a comeback, and Kodak determines that the fair value of the equipment is now $480,000. What amount would you record Kodak's equipment on December 31st, 2025? So the solution is that the carrying amount of the equipment should not change in 2025 except for the depreciation taken in 2025. Kodak may not restore an impairment loss for an asset held for use. The rationale for not writing asset up in value is that the new cost basis puts the impaired asset on an equal basis with other assets that are unimpaired. Okay, accounting for impairments. Let's take a look at that. We talked a little bit about the recovery test, and here the expected future net cash flows less than the carrying amount. If yes, there's an impairment. If no, there's no impairment. So if there's an impairment, we have assets that are held for use and assets held for disposal. Now, we'll look at the assets held for use. The impairment loss is going to be the excess of the carrying amount over the fair value, and we depreciate on a new cost basis. The restoration of impairment loss is not permitted. Now, if it's assets that we hold for disposal, that's going to be the excess of carrying amount over the fair value less the cost of the disposal. There's no depreciation taken, and we can restoration of the impairment loss is permitted in this case. Okay, so here let's take a look at the Norwell company, manufactures miniature circuit boards used in smartphones. On June 5th, 2025, it purchases a circuit board stamping machine at a price of $27,000, inclusive of taxes and installation costs. Norwell estimates the machine will have a 5-year useful life with a salvage value of $2,000 at the end of 5 years. They use a straight line depreciation and employ half-year convention in accounting for partial year depreciation. Norwell's fiscal year ends December 31st. So a half-year convention is when a company gets in the interests of simplicity, they just assume that everything is purchased as of June 30th, half of a year. So that if we buy something in December or buy something in January, it's going to get a half a year depreciation in the first year. It's a simplifying assumption and is used often. Okay, at what amount will the machine be reported in Norwell's balance sheet at the end of 2026? And then during 2027, the circuit board business has experienced a significant competition with more advanced low heat circuit boards. So as a result, at June 30th, 2027, Norell conducts an impairment evaluation of the stamping machine and determines that the undiscounted future cash flows for the machine are estimated to be $15,200, and the fair value of the machine based on prices in the resale market are $13,400. Prepare the journal entry to record an impairment, if any, on the stamping machine. Now, using these same requirements that we just did for Bravo, assume that the estimate of undiscounted cash flows is $17,900, and the fair value of the machine is $12,500. Okay, let's look. So on the balance sheet, our machinery, $27,000, accumulated depreciation, $7,500. Now that $7,500, let's see, is going to be our depreciable base was $25,000. That's the acquisition cost minus the salvage value. Our depreciation expense for 5 years at $5,000 per year. So we take a half a year for 2025 and a full year for 2026. We get accumulated depreciation of $7,500. So that's how we get our $19,500 book value. Then they conduct their recoverability tests by comparing the book value of the machine, $19,500, to the undiscounted future cash flows. And the undiscounted future cash flows are $15,200 given in it. And that's less than the June 30th, 2027 book value of $17,000. So we go back to our cost, we back out our accumulated depreciation through June 30th, and that gives us a book value of $17,000, which we calculated here. Therefore, they are going to record an impairment based on the fair value of the machine and platform to the book value. The entry is loss on impairment, $3,600, and that's this $17,000 of book value less the $13,500 charge here, $400. Okay, and so that is going to be a $3,600 loss on impairment here. And so we'll debit loss on impairment, credit accumulated depreciation dash machinery for $3,600. Okay. Now let's take a look at explaining the accounting procedures for depletion of natural resources. Natural resources such as petroleum or minerals or timber are used in a company's operations. They have two main features: the complete removal, consumption of the asset, and then replacement of the asset only by an act of nature. Let's see what they mean by that. Our depletion base is going to involve four factors: our acquisition costs, sometimes exploration costs, development costs, and restoration. Okay, for example, I watch a movie on the Discovery Channel called Gold Rush, and they buy land and they extract the gold, but they have to put the land back into its pristine condition after they're finished digging up the gold. Restoration costs. Okay, acquisition costs include the price paid to obtain property rights to search and find an undiscovered natural resource. Generally, the acquisition cost of natural resources is recorded in an account titled undeveloped property. Then a company later assigns that cost to the natural resources if exploration efforts are successful. If they're unsuccessful, we write it off as an acquisition cost as a loss. Now, the exploration costs sometimes can be substantial, and some companies capitalize them into the depletion base. In the oil and gas industry, for example, where the costs of finding resources are significant and the risks of finding the resources are uncertain, most large companies expense these costs. The smaller oil and gas companies often capitalize these exploration costs. All right, development costs, some tangible assets like a drilling rig foundation cannot be removed. Companies depreciate these assets over their useful life or the life of the resource, whichever is shorter. Intangible development costs have no tangible characteristic but are needed for the production of the natural resource. Intangible development costs are considered part of the depletion base. Okay. Restoration costs. Sometimes companies incur substantial costs to restore the property to its natural state after extraction has occurred, like my gold rush example. Companies consider restoration costs part of the depletion base. The amount included in the depletion base is the fair value of the obligation to restore the property after extraction. Cost allocation. Here, once a company establishes that depletion base, the next problem is determining how to allocate the cost of the natural resource to the accounting periods. Normally, companies compute cost depletion on a units of production method, and it would make sense. In my example, ounces of gold. Okay, here the Evershine Company acquires the right to use 1,000 acres of land in Alaska to mine for silver. The lease cost is $150,000 and related exploration costs on the property are $100,000, and they are expensed as incurred. Intangible development costs incurred in opening the mine are $850,000. Therefore, total costs related to the mine before the first ounce of silver is extracted are $101 million. That's $150,000 plus $850,000. Evershine estimates that the mine will provide approximately 100,000 ounces of silver. What is their depletion cost per unit? We're going to take the total cost, $1 million, no salvage cost, divide that by the $100,000 expected ounces of silver to get 10,000 ounces, $10 per ounce of silver as its depletion cost. That looks like a good place to stop this video. And when we return, we will take a look at how we present this on the balance sheet. Until that time, bye for now.